In this video, I'm going to break down support and resistance levels, the psychology behind them, how institutions use them, and how you can avoid fake breakouts. Whether you're trading price action, indicators, or just learning the basics, by the end, you'll know how to mark high-quality zones and build better entry and exit strategies. All right, let's start. What exactly are support and resistance? Think of support as a price level, where the market has a habit of bouncing back up. It's like a floor. Every time the price drops to that level, buyers step in and say, "That's cheap, let's buy." And that buying interest can stop the fall or even push the price back up. Now flip it, resistance is like a ceiling. It's a price level where the market struggles to go higher because sellers jump in. They see it as too expensive and start selling, which often leads to a pullback or even a full reversal. But here's the key. These levels aren't fixed. They shift. Markets are alive with constantly changing demand and supply, news, emotions, and big players influencing moves. Understanding these levels is a game changer for any trader. They help you read the market's behavior, anticipate reversals, and make better entries and exits. Support and resistance aren't just technical levels or fancy lines traders draw on a chart. They're actually based on human psychology. Think about it. When price drops to a level where it has bounced in the past, traders start thinking, "This might be a good deal again." That belief creates a zone of buying interest, what we call support. It's a psychological floor because people expect price to bounce. Now flip the situation. When price climbs toward a previous high, where it's been rejected before, many traders start to feel like it's getting expensive again. That creates resistance, a zone where people are more likely to sell. It's not just about charts. It's about how we react to price levels. What's wild is that this shared belief actually makes those levels work. When a lot of traders place buy orders at support, the price really does bounce. And when enough people sell at resistance, it really does fall. That's the self-fulfilling prophecy, and it's powerful. The more these levels work, the more confidence traders have in them. That creates a feedback loop. People remember when price reversed at a level before, so they expect it to happen again and act on it. The level becomes stronger simply because everyone believes it is. Ever notice how price often reacts around nice, clean numbers like 100, 1500, or 10,000? That's not a coincidence. Traders, both retail and institutional, are psychologically drawn to round numbers, especially those ending in zeros or double zeros. These numbers just feel significant. They're easier to remember, easier to communicate, and they stand out on a chart. So next time you see price stalling at a level, remember it's not just supply and demand at work. It's crowd psychology, emotions, and memory. That's what makes support and resistance so effective. One of the biggest mistakes new traders make is thinking support and resistance are exact lines, like price hits $50 and has to reverse. But the reality, markets don't work with ruler precision. These are zones, not pinpoint levels. For example, if a stock usually bounces around 50 rupees, the real action might happen anywhere between 49.50 and 50.50. That range, that's the support zone. Same thing applies to resistance. And here's why that matters. Because fake outs are real. Price often breaks through a level just to snap right back. If you treat support and resistance like fixed lines, you'll keep getting faked out. These quick breaks, they're often caused by market noise, stop hunts, or even algorithmic moves. So thinking in terms of zones helps you stay calm and make better entries, especially when others are panicking. If you've heard of supply and demand zones, that's just an evolved version of this idea. These zones are wider, and they show where big buyers or sellers are likely to act. This gives you more flexibility. Instead of trying to be perfect with timing, you're working within a proven price area. That makes it easier to spot potential turning points and take smarter trades. Now let's talk about something super powerful, role reversal. This is when support becomes resistance, or resistance becomes support. And it happens all the time. Imagine price drops below a strong support zone. When it comes back up, that same zone often acts as resistance. Why? Because people who bought earlier and are now stuck want to exit at break-even. That adds selling pressure. On the flip side, if price breaks above resistance and then pulls back, that same area can now act as support. Traders who miss the breakout may buy the dip, and short sellers may cover their positions. That creates fresh buying pressure. It's all psychological. These zones stay relevant because traders remember them. It's like market memory, and it's what keeps support and resistance valid, even as prices change. So always watch for this flip. It's one of the clearest signals the market sentiment has shifted. Have you ever seen price break below support, trigger your stop loss, and then suddenly bounce back hard? Now let's talk about stop loss hunting. This isn't some conspiracy theory. It's a common strategy, especially in markets with lower liquidity or where big players want to accumulate or exit positions without causing major price movement. Let's say there's a popular support zone around 100. Everyone can see it, and a lot of traders place their stop losses just below, maybe at 99.80 or 99.70. Smart money, institutions, prop desks, or even algos know this. They push the price just below support to trigger all those stop losses, causing a quick flush. Once those weak hands are out, they buy back in at a better price, and the market suddenly rebounds. Same goes for resistance. Price briefly spikes up, hits stop losses of sellers, then reverses hard. The key is to stop thinking of support and resistance as fixed lines. Use zones, give your stop some breathing room, and avoid placing it right where everyone else does. For example, if you're buying near support at 100, don't place your stop just below at 99. 95. Consider going a little wider, say 99.50, where the market would have to make a real move to hit it. Stop loss hunting isn't personal, it's just how the game works. But once you understand it, you can stop being the hunted and start trading like a pro. Identifying support and resistance levels. Not all support and resistance levels are created equal. Some are strong and reliable, others just noise. So how do we separate the real zones from the fake ones? Start by zooming out your chart. It's one of the simplest ways to spot powerful support and resistance. When you zoom out, you can clearly see valleys, peaks, and major turning points, areas where price has reacted sharply in the past. These visible structures often mark strong zones that stand the test of time. Now pair that with time frame awareness. Levels drawn from higher time frames, like daily, weekly, or monthly charts, carry more weight than those on 5 or 15-minute charts. Why? Because big players like institutions operate on those higher frames. When they enter or exit positions, the market reacts, making those zones far more reliable. The more times price has reacted from a level, the stronger that zone is considered. If a support zone has held up 3 or 4 times over weeks or months, chances are it's got real significance. That repeated reaction tells us a lot of traders are watching it. It's like a door being knocked on again and again. If it hasn't broken yet, it's probably solid. But once it gives way, momentum kicks in. You'll also want to look for levels that have flipped their role, what we call role reversal. When a support zone breaks and then acts as resistance, or vice versa, that's a powerful signal. It shows that traders still remember that level and are reacting to it, even after a breakout. Another sign of a powerful level is a sharp reaction in price. Imagine the market falling fast and suddenly snapping back in the opposite direction. Not slowly, but with force. That kind of strong reversal usually means something big happened at that level. Maybe buyers stepped in aggressively, or sellers got trapped. Either way, it signals that the zone has weight and is worth watching. Tools to identify and use support and resistance. Now in this section, we'll break down some of the most effective tools traders use to identify support and resistance levels. When we talk about support and resistance, most people immediately think of horizontal lines. But if you want to get deeper, if you really want to understand where the smart money is hiding, you need to look at something most retail traders ignore: volume profile. Volume profile isn't your usual indicator that draws random lines on the chart. It's a powerful visual tool that shows where trading actually took place, at what price levels buyers and sellers were most active. Instead of showing how much volume occurred in a candle, volume profile displays a horizontal histogram alongside the price axis, revealing how much trading happened at each individual price point. This tool lets you see the invisible hands behind price movement. Now, let's break this down in a way that's actually useful for trading. The most important areas on the volume profile are called high volume nodes. These are price levels where a lot of buying and selling happened. In simple words, these are battlegrounds. Institutions, large players, big volume, they were active here. So naturally, these levels often become strong support or resistance zones. When price revisits a high volume node, you'll often see hesitation, reversals, or even strong bounces. These are the zones you want to pay attention to when entering or exiting trades. On the flip side, we have low volume nodes. These are price zones where barely any trading took place. Now, why would that happen? It's simple. The market didn't spend much time there. Maybe price broke through too quickly, or there was no interest from big players. These zones act like air pockets. When price enters a low-volume node, it tends to move very quickly through it. That's why they're often ideal for breakout or momentum trades. There's less resistance, less friction, and often more speed. But the most important point on the entire volume profile is the point of control, or POC. This is the exact price level where the highest amount of trading happened during the selected range. Think of it as the fair value for that time period. If price is above the POC, we can consider the market sentiment to be more bullish. If it's below, there may be bearish pressure. It's a gravity point. Price is often drawn toward it, especially if it strays too far. Now comes the big question. How do you choose the right range for the volume profile? And honestly, this is the part that most people get wrong. Volume profile only makes sense when applied to the right section of a chart. You don't want to slap it on the entire chart randomly. Instead, you want to use it on specific market structures like a clear swing high to swing low, or a sideways consolidation range before a breakout. You could also apply it to a recent price rally or the correction that followed. If you're day trading, you can use it on intraday ranges. Maybe apply it from the start of the trading session to the present moment. The goal is to understand where price has been accepted or rejected within a context that actually matters to your time frame. So instead of relying only on traditional support and resistance lines, use volume profile to validate them. Let it tell you which levels are actually backed by serious trading activity and which ones are just empty space. For a more detailed explanation, I've covered volume profile in a separate video on my channel. Be sure to check it out. When it comes to intraday trading, one tool stands out for its consistency and clarity, and that's the pivot point. Pivot points are widely used by professional traders to anticipate potential support and resistance zones for the current trading day. Unlike lagging indicators, pivot points are calculated before the session even begins. They use simple data from the previous trading day, the high, low, and closing prices, to project where price is likely to react during the next session. It's important to understand how they're structured. At the center of it all is the pivot point, P. This acts like the equilibrium or balance point of the previous day. From there, you get support levels, S1, S2, sometimes S3, below the pivot, and resistance levels, R1, R2, R3, above it. These levels essentially form a predictive price map that traders use to plan entries, exits, and stops. So how do we actually use pivot points in a live trading environment? It's fairly straightforward. If price opens and stays above the pivot level, it often indicates bullish sentiment. The market has upward momentum. If price stays below the pivot, that's a sign of bearish sentiment, and traders look for short opportunities. When price approaches one of the pivot levels, like S1 or R1, traders look for a reaction. If price touches S1 and bounces upward, that's often considered a signal to go long. Likewise, if price touches R1 and gets rejected, it could be a short setup. These setups are called pivot point bounces, and they're one of the most popular uses of this tool. But sometimes, the market doesn't bounce. It breaks. And when it does so decisively, we get what's known as a pivot point breakout. This is when price pushes through a support or resistance level with strength, often signaling a trend continuation. In that case, traders may enter in the direction of the breakout, using the next pivot level as the next potential target. Pivot points also offer a logical framework for stop-loss placement. For example, in a long position off of support at S1, a stop can be placed just below S1 or the main pivot level. In a short position from R1, the stop might go just above R1, or the central pivot. And while pivot points are most commonly applied to the daily time frame for intraday trading, they can also be adapted to hourly, 15-minute, or even shorter intervals, making them incredibly versatile across different strategies and trading styles. What makes pivot points unique is that they are objective. Every trader using the same data will get the same levels, unlike subjective trend lines or zones that vary from one person's chart to another. As we continue exploring the most effective methods to identify support and resistance, it's time to introduce one of the most iconic tools in technical analysis, the Fibonacci retracement. Now, if you've ever spent time studying charts, you've probably come across those horizontal lines: 23.6%, 38.2%, 50%, 61.8%, and sometimes even 78.6%. These aren't random numbers. They're derived from the famous Fibonacci sequence, a mathematical pattern found everywhere in nature, from sunflower spirals to galaxy formations. But in trading, Fibonacci levels serve a very specific purpose. They help us identify potential areas where price might pause, reverse, or bounce during a pullback within a trend. So how does this work in practice? Let's say the market is trending upward. Price rallies from a swing low to a swing high. Now, naturally, the market doesn't just go up in a straight line. It pulls back. That's where the Fibonacci retracement tool comes in. You take the tool in your charting platform, click at the swing low, drag to the swing high, and the retracement levels will automatically appear. These levels act as potential support zones where buyers might step in to resume the trend. And in a downtrend, it works the same way, except you start from the swing high and drag it down to the swing low, marking potential resistance zones where sellers could re-enter the market. Among all the levels, the 61.8% retracement, often called the golden ratio, is considered the most important. It's a key psychological point where many strong reversals tend to happen. Now that we've covered fixed levels like Fibonacci and pivot points, let's move into something a little more fluid: moving averages, a powerful tool for identifying dynamic support and resistance. Unlike horizontal levels that stay fixed, moving averages shift with the price. They move because they're based on recent price history, creating a flowing line that updates with each new candle. And this line, more often than not, acts as dynamic support in uptrends and dynamic resistance in downtrends. There are different types, but the most common are the simple moving average, SMA, and the exponential moving average, EMA. The EMA responds more quickly to recent price changes, making it useful in fast markets. Shorter period MAs, like the 10 or 20-day, are typically used for spotting short-term trend pullbacks. Meanwhile, the 50, 100, or 200-day MAs help track broader trend behavior. But the key point is this: moving averages adapt. They shift with the trend. That's why they're so valuable when the market is trending cleanly, but less reliable in sideways or choppy conditions. For stronger signals, traders often look for price action confirmation at the moving average. For example, a bullish engulfing candle forming at the 50-day MA in an uptrend, or a shooting star rejecting the 100-day MA in a downtrend. These patterns help confirm whether the moving average is likely to hold. And of course, the longer the period, the more significant the level. A bounce or break at the 200-day moving average isn't just technical noise. It can signal a deeper trend shift. It's important to remember that moving averages are lagging indicators. They reflect the past, not the future. So while they help you read structure and trend, they're best used in conjunction with other tools like volume, price action, or support and resistance zones we've already discussed. Conclusion: support and resistance aren't just lines. They're reflections of market psychology and the constant battle between buyers and sellers. Whether drawn from price history, volume, or dynamic indicators, these zones help you see where the market might react next. Master them, combine tools for Confluence, and you'll trade with clarity, not guesswork. That's it for today. Thank you for watching.